Good evening. This is the Angry Capitalist doing the Angry Capitalist podcast. I hope you're doing well this evening. I'm experimenting with different intros, so thank you for putting up with that there. So, on this episode this evening, I'm going to go ahead and cover a topic that is known as house hacking. Effectively, what house hacking is it is the practice of owner occupying a residence or a multifamily home and then using rent from one or more units to help offset the cost of living. So, for example, if you buy, in my case, a duplex, your tenants in one of the units will help to pay for the mortgage cost and the cost of owning the property. Sometimes you can manage to completely cover the cost of the building with the rents from one of the units. However, typically you have to put something towards the monthly payment. That being said, though, it's a really good way to get started in real estate. And really, the goal with doing house hacking, especially as someone who is getting started in life or starting to build their position, is to build a really solid and resilient financial foundation to then go ahead and build your life off of. As we get into this discussion, something I want you to keep in mind is with any asset acquisition, the key is to buy a good asset at a good price. Before we dive into the meat of today's topics, which will be house hacking deal analysis, there are a few things I want to go over, a few what I refer to as real estate myths. The first is that real estate always goes up in value. The reality is real estate is a commodity market, and depending on where you're at, you will have fluctuations going in an appreciating direction or a depreciating direction. Even if you were able to get in back in 2008, I would strongly disrecommend buying real estate in the wrong part of Chicago or in the wrong parts of Detroit. Your local market has a large influence on what you can expect your real estate to do in terms of its cash flow as well as its equity valuation. Further, this is a little bit off topic, demographics. So if you right now were to pause the video and Google declining demographics, if you do that, you'll notice that some countries, Japan, Korea, Germany, and China being the primary examples, have a decreasing population. So with real estate, remember, its value is a function of supply and demand. So if you have less people, your supply drops. Or your demand drops and your supply stays the same or continues to increase. So it doesn't always go up. It's a little bit more complicated than that. That being said, however, it is still a pretty good asset class. The second real estate myth, especially if you're looking to rent to people and you're looking to take in rental income, Section 8 is guaranteed income. That is sadly not the case. Individuals can be kicked off of Section 8. Typically, they have to do something wrong. However, depending on your state's laws and perspective regarding marijuana, they could lose that due to something as simple as they caught a charge involving an ounce of weed, which personally, I don't care what consenting adults put into their bodies, but that could lose that potential source of income that they rely on. There are a few other things that can happen as well. If they have some kind of misconduct, with Section 8, that varies state to state, as well as if they get some kind of a charge or conviction against them, that could also cause them to either lose it or have to reapply. Additionally, many states don't have great policies if your tenant's income, not including Section 8, but if their income were to increase, they may face a deduction on the Section 8 or an outright loss of it. So the point is that what I'm getting at with that is that's a complicated topic and issue. It's not guaranteed. Third, your primary single-family residence is an investment. This is something that I push back on quite heavily. It's an investment in terms of your shelter, but the idea of buying a single-family house and then relying on that as being your primary asset in terms of your net worth is, in my estimation, a very dangerous mindset, and it's not conducive towards building wealth. Now, sure, however, if you have some kind of a business that's being done out of a single family house and it has some kind of a dual purpose, then you may be able to go ahead and consider that as an asset. But that's not very common unless you're something like, let's say you're an attorney or an accountant and you have a home office where you do your business and you have people visit you at your home office. That's what I'm kind of referring to with a dual purpose. That is a very good option for taxes, by the way. Okay, now, as we dive into the meat of today's video, of course, a brief disclaimer. The purpose of this video is for financial and economic education. Your specific situation could vary greatly, so don't take anything in terms of what I'm going to discuss as financial or tax advice, because this can vary depending on your situation and your state. I recommend doing your own due diligence before you make any kind of investment decision. Additionally, it may be a good idea to go ahead and consult with a professional CPA or a financial advisor about your specific situation. Now, to get into it, when it comes to a multifamily property, and these are my perspectives on this, so keep that in mind. A good multifamily property for the purpose of house hacking should meet the following criteria. The location has stable or improving median household income. Additionally, you want to find an area with a diversified economy. I threw out a bit of jargon there. Don't worry, I'll go ahead and break it down a bit. Effectively, you want people's take-home income to be relatively stable, if not increasing. Granted, of course, if you're buying into a dip in the housing market, you may have to negotiate that carefully. When I refer to a diversified economy, what I'm really meaning there is you don't want to invest in an area where it's a one town or it's a one pony town. So it's like there's a factory and everyone works at that factory, and all of the other businesses are set up to service people that work at the factory. The factory's needs itself. What I'm getting at is you don't want to find a place that if it loses one major employer, you're totally fucked. So you want to find a place that has a good mix on the economy, and you have a pool of different people that you could rent to, who, if one person loses their job and has to move out or you have to evict them, if that company's not doing too well, there are people that work for other companies that ideally will be in a better situation that you could then rent to. Your tenants are customers. You have to do some thought on what kind of customers you're going to bring in. The structure itself. So the structure for a house that you're looking at house hack, it should have no major repair needs, at least for the next upcoming 10 years. Now, if you get into real estate more in depth, or if you've been in construction a while, it's okay to play with that a little bit. However, for the purpose of getting started out, the reason that I make that recommendation is I don't want you to be hit with any surprise, major multi-$1,000 expenses when you're first getting started out. Enough smaller stuff can and will go wrong that you'll need to attend to. You don't need to set yourself up for failure from the get-go. So avoid any major repairs that'll have to be done in the next 10 years. That includes stuff like the foundation, roof line, timbers, the actual structure, the electrical is not up to code, stuff like that. A note on that as well. It's one thing to buy a property with clear improvement opportunities, but these should be non-emergencies. For example, in my situation with this duplex that I'm house hacking, I recently, this past year, had the electrical panels. I had those upgraded from 100 amp to 200 amp by an electrician, but that was not an emergency situation. One of the reasons why you may want to do repairs like or improvements like that is to increase the value of the asset. Or the property should be move-in ready. So the property may already have tenants, but it should be in a condition to where you as an owner-occupier can move right in. Additionally, you can go ahead and as soon as you buy that asset, you can get a tenant in there. Once again, if you're getting started doing this, especially for someone doing house hacking as you're starting real estate, don't set yourself up for failure by potentially having a month or two before you can even move someone into the building. Additionally, this gets more into the weeds, and this is why when you go to buy real estate, if you want to do a purchase by the owner and not have a real estate agent, that is your decision. However, I strongly encourage you to always bring on an attorney. Reason being is you want to make sure the title or deed has no outstanding liens or tax delinquencies on there that you may be hit by after you become the owner. If there are any pre-existing tenants, they should have a good payment history. And that is something that as you're in the process of evaluating or considering buying a property, you should request some kind of documentation from the prior owner. It may not always be possible to get that, especially if they're paying in cash and if the owner was, let's say, not reporting on their taxes. But you should inquire about that kind of thing and really push to get some kind of documentation of the tenant payment history. Additionally, if there are any kind of legal complaints or anything like that, or let's say, for example, if the tenants tried to litigate, meaning sue the prior owner, you should also request that kind of information too. When you bring on your lawyer, I recommend you also talk to them about this, even if it's just a quick 15-20 minute phone call. Or if you communicate to your real estate agent, be like, hey, I want to have these different things checked prior to moving forward on this, or have the seller provide documentation about these. Now, the next two parts. This can get a little bit tricky because now we're going to dive in and do some math, okay? So part one will be how to find a valuation, or how to place a valuation on the property. This is where you're going to stop and ask yourself, okay, I have some different multifamily properties that I'm looking at in my area or in the area that I want to buy in. What's a good purchase price? What can I handle in terms of a monthly payment, that kind of thing. and how do you evaluate a good property? A quick note on that, the valuation and analysis method that I'm going to be discussing with you today is a method that I was shown by my grandfather and my uncles. There are all different methods out there, but this is what I personally use and recommend. Additionally, once again, when it does come down to this kind of thing, and when you do go ahead and potentially purchase an asset, do some of your own due diligence on this process just to see if there may be a better valuation method for you. But this is what I recommend. So, step one, and this is strangely one of the most important, is find out what the average rents are for similar units in your area. So let's say, for example, you have a duplex that's a side-by-side, 2-bedroom, 1-bath, 2-bedroom, 1-bath. You should not just be looking at the real estate in terms of a purchase perspective, but you should go ahead and check. Once again, you can go through Zillow or just do an open Google of apartments in that area. So you can type in 2-bedroom apartments for rent. Get an idea on what rents are going for. Maybe compile a list of different pricing for similar units and find the median or the average or whatever appears to be closest to the quality of the units that you have, both in terms of square footage as well as furnishing, parking, etc. That can get a little bit complicated. If it seems like a bit much, and if you get into paralysis by analysis, just go with whatever the average is in your area. Next, there's something that's called CapEx. What CapEx is? Your capital expenditures. This is your monthly expenses for maintenance and repairs that you may incur. This is both things that you're going to incur month to month, as well as various costs that will come and go, so to speak. Usually, CapEx is 5 to 10% of your annual rents. So let's say, for example, you're bringing in $20,000, your CapEx would be 5 to 10% of that. Personally, I prefer to go with a 10% amount when I'm evaluating a property, just to give myself a little bit of wiggle room. Next, you want to determine your vacancy rate. What that is the percent of the year that you may end up going, that your unit may end up being vacant. For simplicity purposes, I typically go with 1 month, and that would be 8%. So once you've determined your annual rents, you want to go ahead and subtract out your CapEx. So you want to subtract, let's say, 10% and your 8% vacancy rate. So take your annual rent, subtract 18%. You then want to take this and multiply it by an earnings multiple. 10 is very common. I'm not going to dive into the weeds on what multiples are and why they're used. It's just a common metric that is used to take some pieces of data and give the building, the assets, some kind of a value. So 10 is a very common earnings multiple. So take the annual rent, less CapEx, less vacancy, multiply it by 10. This number that you're going to get should be approximate to the total cost to acquire the property, including debt service, down payments, closing costs, including your interest, or my apologies, including your attorney's fees, fees for realtors, inspection costs, all that stuff. So your closing costs, debt service, and whatever you put down in terms of a down payment. that added together should be approximate to that valuation. Once you have that valuation, you want to divide it by the number of months that you're looking at in terms of your mortgage, or really this would be more appropriate to describe as the depreciation. The way that it was taught to me was, you're going to go with a 30-year mortgage because you want to push that out, so 360 months. So you want to divide that by the number of months that your mortgage will be. Well, it's very common to use the 360 months because it lines up with your mortgage. In my estimation, and this is a tweak that I'm making to it, is typically if you buy a property, you can depreciate that for 27 years, and that varies state by state as well as year by year based off the federal tax code. But typically, if you buy a property, you can depreciate that, 25, 30 years in that ballpark. That gets into the tax aspect, not to go too deep into that, but you're going to effectively depreciate and count that depreciation as a tax write-off. Talk with your CPA or accountant on that in more depth, but that's one of the reasons why we divide that out as well. The resulting number, so once you've taken your annual rents, subtracted your capex, subtracted your vacancy rent, divided it by the number of months that your mortgage will be or that you'll be depreciating the asset for, so 360 months, that resulting number should be approximate to your principal and your interest. Your actual mortgage may be half or twice that or even higher, because that will also include stuff such as your insurance, whether you're getting mortgage insurance, insurance on the asset itself, liability insurance, flood damage, etc., as well as various other just random fees that'll be thrown in there too. Your escrow, your taxes, all that stuff will be lumped in together. So your actual monthly payment is going to be higher than that, but that should line up somewhat with your principal and interest. Next, we're going to go over the analysis, and I'm actually going to go into a spreadsheet. So for those of you who, if you want to watch along and see this visually, I'll cover that with you in a sec. We're going to go through this twice to help reinforce everything. Next is the analysis. So we're going to break this down to more of the month-by-month level instead of just getting a valuation on it. So for analysis, you're going to take your annual rents and other income. Other income would effectively be stuff such as, let's say, for example, you have a laundry machine that's coin operated. Or if you charge a little bit extra to cover an increased water bill, let's say, for example, you let your tenants put up a pool, or you charge extra based off of an AC unit. I had a place that I rented. They charged an extra $100 for the summer for you to put an AC unit in. I thought that was kind of silly, but that's how they ran stuff, and I am not living without AC. So if there's other income coming as well, you'll combine that in with your annual rents. And that's projected, by the way. If you can get historical other income from the prior owner, do so. So then you're going to take that annual rent and other income, subtract out your vacancy and capex, so minus 18%. Then you're going to go ahead and take out your mortgage amount, annual mortgage. So get this from a calculator such as Zillow, for example, or as you're working with a loan officer, you should be able to get this from them as well. So your total mortgage amount, once again, will be your principal, interest, insurance, taxes, etc. Fourth, we're going to take out owner covered expenses. Once again, the situation where I was talking about how I had to pay extra for an AC unit, that's because the owner covered electric as well as heating. Typically, it's water and sewer that you're covering. But if there's anything else, go ahead and subtract that as well for the year. When it comes to the water and sewer, by the way, once again, if you can get historical data in some kind of an official capacity from the seller, awesome. If not, check around in the area. Maybe even ask your realtor to dig that up for you. Fourth, we're going to take that remaining number after we've subtracted the CapEx, vacancy, the mortgage amount for the year, and owner covered expenses. We're then going to take that annual profit or loss and divide that 12 months, or divide that by 12 for the months in the year for your monthly profit or loss amount. So I'm going to go ahead and pause this real quick, and I will do a share screen with you. Be right. Okay, here we go. So once again, this is a method that I use. So if you look around, if you don't care for this method, or if you just want to find something that's a little bit fancier or suits your needs for whatever reason, by all means, go ahead. You can do a simple Google for real estate valuation calculator spreadsheets, or you can find other calculators. Bigger Pockets has one, if I remember right. I just use a spreadsheet that I put together. So, valuation calculation. So here we have rental unit 1 and rental unit 2. I changed these up just to give it a little bit of variety here. So these are projected rental amounts based on similar rent listings. Something that I do recommend doing, by the way, when it comes to this is discount what you think it'll go for slightly by like 10 to 15%, just to give you a little bit of wiggle room. It also is a good idea to check what the trend is for rents in your area. So in some areas, you're going to have rents that will increase and decrease depending on what the economy is doing. So do some research on that, figure out what the trend is, maybe discount it a little bit more, but I don't recommend increasing it beyond what similar listings are going for. That's just going to set you up for failure. So here we have rental unit 1 is a 3-bed, so it's $1,400 for the month, and rental unit 2 is 2-bed. It's also a little bit smaller square footage, so $1,000 per month. Here we have our CapEx, 10%, vacancy, 8%. Remember, that can be 5 to 10%. I prefer to be a little bit more on the conservative side, the safer side, so I go with 10%. Then we have our annual rents, vacancy, and CapEx. So that is the amount of vacancy and CapEx for the year. So the rents are $28,800. Vacancy and CapEx comes in at $5,184. A quick note on vacancy and CapEx. It's not like you're going to spend the same amount every month, and that number will also vary year to year because crazy shit happens. You have accidents, weather damage, tree breaks, damages the roof a little bit. Stuff will happen. So what I typically recommend doing, and I'm going to touch on this again in the analysis portion, is contribute to a real estate account. I recommend a savings account where you'll put a little extra in beyond just what you have to pay for the month for your mortgage to go towards your CapEx. That way you're steadily building up a little bit more of a buffer for these inevitable repairs. You could also use that money for improvements. So we have our annual rents less vacancy and CapEx, $23,616. And by the way, I have this spreadsheet set up so that if we change various values, it will adjust by itself. So let's say, for example, we can only get this for 1,200. Boop. That will cause all these other numbers to adjust slightly. Put that back to the 14. Enter. Okay. So we have our annual rents, less vacancy and CapEx. We then have our earnings multiples. So we're going with 10 times earnings to get a approximate valuation. Depending on what the real estate market is doing, it may be above, it may be below this. This is your target that you should be willing to spend on for an asset based off the expected cash flow. So especially if you're in a very hot housing market, or as I believe right now we're in a housing market bubble, it's entirely possible you're going to have to look at a few deals because you'll do the numbers on it based off the expected rents, and they'll want way more for it than it's worth. This number here, once again, this is not this 236, 160. This is not what the sales price should be. The sales price should be well below this. That should be the principal, interest, closing costs for the total cost to buy that asset. So that would be, for example, use like the loan calculator on Zillow, look at what your total cost to buy the house is over your 30-year term. It should be approximate to this. We then have our loan term. So 30 years. This is also the amount of time that we can depreciate the asset for. And so for the asset valuation, we're going to depreciate that from, what you effectively paid for it all the way down to 0. So we're doing 30 years, 360 months. So your monthly principal and interest should come in around this 656 mark. It may be a bit higher. Remember, it doesn't need to be super exact to this. We're trying to give you an idea for what this building is really worth. Before we go over to the analysis part, some people talk about appreciation. As I brought up previously, demographics for the US, it's kind of flat and it may decrease in the future. So I don't really factor in depreciation or appreciation when I'm looking at real estate. Additionally, in my estimation, if I do get any appreciation on the asset, that'll most likely just be the result of the inflation of the currency, not necessarily that my building that I bought got any more valuable. If it does, awesome, sweet, that's great news, I'll take it, but I'm not counting on it. I'm not factoring that into what I'm willing to pay for an asset. Going on over to analysis. Okay, cool. So here we're now looking at the monthly picture. And this is where we can go ahead and adjust stuff based off of the perspective of house hacking. So we have our annual rents, $28,800. Other income, I didn't put anything in here for other income. Once again, this could be like if you have coin-operated laundry, if you have the tenants pay for other amenities. The guy who used to own this place, he provided internet for his tenants and charged extra for that each month. We then have our vacancy and CapEx. Once again, this is being filtered in from the other page. So if you're familiar with spreadsheets, you'll see this formula up here, valuation B10. That's actually pulling the number from the other page. So if you need to play around with this at all, feel free to, and you can find other calculators out there if you want. We then have our annual mortgage payments. So this is for the purpose of your annual mortgage payments as well as your monthly mortgage payment. calculating a mortgage can be pretty complicated and easy to mess up. I did not include this in this calculator. I just used the one on Zillow. Additionally, because there are going to be other inputs that will vary depending on your area, such as your insurance costs and your likely taxes. Zillow can go ahead and pull that info from the property's history or from the surrounding area and get you a much, much more accurate idea on what you'll be looking at in terms of a mortgage than what I could put together through a spreadsheet for you guys. Load there. Sorry for the slight distraction. My cat just came over and bapped me on the shoulder because he wants to go to bed. Okay, we now have owner covered expenses. This is a little bit different from the vacancy and capex. And the way that it's different is this is going to be stuff that you're going to cover month over month or quarter over quarter that is not going to really vary all that much. This is stuff like your water bill, water and sewer, two of the most common examples. Or let's say, for example, you're a saint and you provide internet for your tenants and you don't charge extra for it. You could go ahead and roll that up underneath owner covered expenses contained within. Okay, we now have annual income less your vacancy, capex, mortgage payments, and owner covered expenses. So this is your annual income or profit based off of those numbers that we've ran so far. And then divided by 12, we have our monthly income or loss for the property. Now, these two figures here that are highlighted in yellow, this is if it's fully rented. So when it comes to house hacking, we are looking at it as we're going to live there for a time, have that help to cover our cost of living. But these numbers here are set up as if it were fully rented. So as an example, this will give you a rough idea on what you'll be looking at once you eventually move out of that multifamily house, maybe into another one, maybe into a single family, and fully rent it out. So this would be your rough idea of your monthly income or monthly loss. Excuse me. Didn't want you guys to hear me burp right there. So right here we have our monthly mortgage. Once again, take this off Zillow or Realtor or your choice of real estate site. They typically have a mortgage calculator on there. I just put in 1,500 because it's approximate for a duplex in my area. And here we have our monthly contribution to your capex account. So here we've taken the vacancy and capex and divided that by 12. I'm actually going to go ahead and edit this on the fly. One sec. So what I'm going to do in this is I'm going to actually include the owner covered expenses because you want that in there too. Let's make sure I've got that right. B6 and B8 divided by 12. Okay, good, cool. So this amount here is our monthly contribution, to your capex account. As I was saying previously, I highly recommend setting up a separate account. I use a savings account because I may as well as get interest on it. And it's not like I need a debit card for this kind of thing, where each month you're going to go ahead and deposit your rental income and whatever portion you have to pay into the account per month that'll cover both the mortgage as well as your CapEx. Now, this gives our owner occupy portion. So this is your real rent to owner occupy this multifamily property. So in this situation, we're looking at $665, and the tenant's rent, once again, is connected to the other page, is $1,400. So think of it like this, right? We're getting you started in real estate. You're practicing the skills, you're evaluating a property, you're buying yourself someplace to live that you'll be in charge of. And if we go back to this other page, normally to live there, you'd have to pay, $1,000 per month, plus utilities perhaps as well. But by house hacking, you only have to pay $665 per month. So that can be hypothetically $665 within this framework here. But this can be a really good way to reduce your living expenses as well as to build some wealth for yourself. So I hope you guys really enjoyed this kind of video. I am not covering the tax projections today in this video. I'm looking to do a separate one on that in the future. I will say, now that I've been living here at this place for a few years, house hacking can be very exciting from a tax perspective. Why is it exciting? Because fuck the government. I don't want to pay any taxes I don't have to. And so this is a really good way to potentially lower your taxes. So I may go ahead and also share this with, there we go. I may go ahead and link that calculator down in the description or in the comments below. So if you like that kind of calculator, or if you want to play around with it yourself, just to get a feel for the numbers, see how things respond, maybe look at some deals in your area, I'll go ahead and link that down below. If you liked this video, go ahead and hit the like button. Additionally, if you look forward to more content like this, house hacking, tax strategies that you can potentially implement, general financial education and wealth building techniques, please go ahead and subscribe. Don't forget to ring the bell. YouTube hates anyone who is trying to improve themselves. So you want to make sure that you'll ring the bell so you get notified when I upload videos like this, especially because I'm going to do more videos in this series. So thank you. Have a good evening and take care.